Welcome to News You Can Use in your personal and professional lives. Hi, I'm Dan Finn, and for the past 30 plus years, I've been helping clients achieve long-term financial success and security through the strategic implementation of tax advantage assorted specialty annuity products and services. I want to thank you for the opportunity to be of service to you today. Today, we're talking trusts with our special guest, Christi Freed, President of Continental Trust Services, LLC in Boston. Now, Christi herself has been a licensed insurance and financial professional since 1993 and brings a wealth of experience and knowledge to her current position. She's a licensed fiduciary and a nationally certified guardian, fully qualified and authorized to handle a full spectrum of situations requiring professional trustee services. Christi's background in and experience with structured settlements sets her apart from a lot of her peers who do not appreciate the unique advantages structured settlements bring when combined with trusts. And full disclosure here, I've known Christi almost the entirety of both of our careers when she represented life insurance companies we were appointed with. And I've always enjoyed her presentations when I saw her in industry functions, and I'm honored she's agreed to share her insights with us here today. Welcome, Christi. Thanks for joining us.
Well, Dan, thank you so much. I really appreciate the opportunity to talk to you and your audience about some of the information and situations that we've seen ourselves up against in the last year.
Perfect. So glad to have you. Now, in advance of this, we got some things we're going to get to in a couple slides, but before that are really great. I think our audience is going to love. But before we get to that, we kind of just to set the stage here, we talked about this earlier, just generally for anybody who might not know, why would somebody anticipating a personal physical injury settlement, why would they consider a trust? Now, we've talked about this. You gave me a couple bullet points. I'm just going to put them up here randomly, let you talk about them as you see fit, and then we'll move on to the next ones.
Yeah, that's right. So I get calls every day in my office from families across the country, a couple of international clients, but basically what we're doing is we're working with families that are settling personal injury lawsuits, and there's a couple of different reasons they would consider a trust. Number one, they want to preserve their government benefits. So they're catastrophically injured and they're not going to work again. So they need that Medicaid coverage or Medicare. Maybe they need their SSI benefits, Medi-Cal, it's called. Medicaid's called various things in various states. Here in Massachusetts, it's Mass Health. So we can help people set up a special needs trust to preserve those government benefits. Another reason people call is because there's been a minor that's been injured. So in some states like Texas, the law wants you to put the money into a trust so that you can work with the family to make those monies available to the children before they're age 18. We do a lot of transportation, tutoring, supplemental therapy, equine therapy, things of that nature. Another reason is because one of the clients might be incompetent. They might have a guardian of the person or a guardian of the estate. And so their trust assets are separate and distinct from those areas. And so we work with the team of family and professionals that they've got on board so we can increase the quality of life for incompetents. We have other individuals who are looking at their settlement and they're saying to themselves, this is a lot of money. And, not to sugarcoat it, but I don't think a lot of us can deal with an influx of 6, 7, maybe even 8-figure settlements. In that regard, you've got families that are trying to make decisions at the time of settlement, which is a very hectic time, and they're getting a lot of input, maybe not only from their attorneys or their professional accountants, but also from family and friends. And there are people who are looking out there going, you know what, hang on a minute, I need some help. I need someone who's going to work with me, who doesn't have a vested interest in the outcome, that will help me with the spendthrift protection, help me get this money to last my lifetime. And then last but not least, we certainly have individuals who say, look, we've got the structured settlement, we've got a plan together. We'd like to put the money into a trust so that we could also participate in the market and get some growth potential in here. And so these are the reasons why people call us.
And of those people that do, what would be some reasons? What would be some of the drawbacks? What would be bad about this? Or what are,
There's two things I can tell you, quite honestly. Number one, it's not easy standing between a person and their settlement monies. Being the gatekeeper to that and keeping everybody on board, whether we're protecting government benefits, whether we're working with children or incompetence, doing that spendthrift protection, at the end of the day, a lot of my job is about budgets. Budget, budget, budget. And there's not anybody that I know that particularly cares for that. But, when you put a lot of time, effort, and money into planning how things are going to go, then your trustee should be there for you to implement that plan. And also, it's a living, breathing document. No budget is set in stone. So as things change and opportunities occur, or maybe some setbacks are experienced, we can make those changes. The other thing that I've heard about, and this is the reason why I got in this business, are proprietary products. Without going too far into it, I know that there are some individuals or organizations that serve as trustee that also have financial products. And they're interested in having the monies invested in their proprietary products and maybe not spending it to increase the quality of life for an individual in a manner that an independent trustee would do so.
I can kind of, when you say that, I can kind of envision like an institutional place where maybe advisors are coming in and out all the time. Maybe there's a new advisor, maybe there's a new product that they want their advisors to promote. And so they may feel pressured to put something in that might be good for the individual, but might not necessarily be the best thing. So
one of the things that we run up against time after time is a lot of the investment advisors really looking for high net worth individuals. And if you look at the definition of that, it's pretty straightforward. And I think some people are making the mistake of bringing that philosophy over to our clients here in the physical injury marketplace. Because although these awards might be large dollar figures, we are dealing with catastrophic injuries with people most likely not going to work in the future. So it's a lot different. There's a different mindset to it.
Right, understood. You mentioned it a bit ago. You're brought to this brought to this industry with a structure background. A lot of people think it's one or the other. It has to be either in a trust or a structured settlement. You can't do both. You and I both know that's not true. So why don't you just tell our audience why a structured settlement fed trust is kind of a good idea?
So as a trustee, when I'm selected, I'm given the responsibility by the family, the court, the state, and the federal government to protect this money and spend it in a manner that is going to be prudent. So we've been hearing a little bit about these individuals that are coming up and talking to people and saying, well, hang on a minute, let's look at the structured settlement annuity. Let's look at the cost of a stock. Let's look at the bond market. Let's look at a blend of things. And, one of the things I find time and time again, and I've been doing this, Dan, I've been doing this since I got out of college, so it's been a while. Gosh, it's been about 30 years. But, one of the things, you look at a structure, and a structured settlement looks and smells like a fixed income bond. And when you look at what you're getting in a structured settlement annuity, let's not forget, you're getting guaranteed payments, you're getting lifetime benefits, and you're also getting the advantage of using a rated age. When you're looking at those, and you're getting institutional management, and you're looking at those internal rate of returns, what are you going to compare them to? Well, I compare them to a collection of bonds, investment grade municipals, treasuries, and a couple of corporates. I like to look at corporates that are kind of rated at or above the United States government. But at the end of the day, the price of those individual bonds coming together to actually build something similar to a structured settlement. And remember, those bonds don't offer lifetime guarantees. It is
so
the
pricing,
risk.
Yeah, pricing seems to be better for the same basically comparable risk products. The structure yields are probably going to be a little bit better than the bonds you're talking about.
That's right. That's absolutely correct. That was a very short way of getting to the answer that I was taking a long way through. Sorry about that.
No, it's all right. No, good.
Then we were talking about how we can more efficiently meet reoccurring expenses. Well, when you've got a structured settlement, let's say you've got $250,000 that you're going to seed a trust with, and then you have a structured settlement payment coming in monthly, quarterly, annually. That's a guaranteed income. That's something that myself as the trustee and the family can plan around. Knowing that we're getting that money in, it makes it more efficient for us to meet reoccurring expenses. And it lowers the volatility of the entire settlement when you've got something that's constantly streaming in. Very much kind of like a paycheck. When you go out and you're working for a living, you do have a savings account or maybe some sort of inheritance or a block of funds that you're working with, but then you're working for a living and you're getting that periodic payment into.
And before we move on to the next one, which where it really starts getting good, I think.
Sure.
The whole lifetime income thing with the rated age advantage. You with a life company background, tell our viewers what that you mean by rated age and how that works and how that can be beneficial to a trust and you as a trustee.
Sure. Yeah, absolutely. So let's take a 51-year-old woman, and let's say she has diabetes. If you go and get a standard annuity, then, let's say we've got a $500,000 settlement. We go and we get a quote for this 51-year-old female. That's going to net you about $1,000 a month for the rest of her life. Now, let's say we've got some medical information that says she's got diabetes. Well, the life insurance company employs substandard underwriters, and their job is to take a look at those medicals and say, well, wait a minute, what do we have here that's going to affect the life expectancy of this person? Well, diabetes is definitely going to shorten one's life expectancy. So in this case, let's say it's going to take 10 years off of the otherwise healthy life expectancy of a 51-year-old woman. Well, when they go to price out those annuities, instead of using age 51, they use a rated age plus 10, which would be 61. So now this $1,000 a month becomes something around $1,250. And that rated age really benefits the injured party because it puts more of the onus on the life company to make those payments for a guaranteed lifetime expectancy.
A lot of people don't realize that you mentioned diabetes. So a lot of conditions that have nothing to do with the accident, those can definitely factor into it. And then also there's no law that says you have diabetes, you can't live a normal life expectancy. Statistically, people don't. They die earlier than people that don't. But we know a lot of people with diabetes, if they treat it properly, they can live a full normal life expectancy. So they get the benefit of the better pricing as no extra cost, which is great.
That's right. Let me just interject real quick. When you take a rated age and you use it on making your decisions, that rated age is putting all the risk on the life company.
Good point.
So you're taking all of your information, you're passing it along, trying to get the best benefit for you and your family, and leaving the risk with them.
Got it. Okay, now getting into the part that's really prompted me to want to have you on and talk to everybody is the all cash versus structured settlement Fed trust. I'm seeing a dangerous, irresponsible, I believe, trend where some cases are settling that are perfect candidates for structured settlements, but for whatever reason, they're being advised or counseled by somebody that they should forego a structured settlement altogether because the rates are too low. And it should go into trust because I can get these kind of returns instead. And you're going to be much, much, much better off with an all cash trust. You told me, said, boy, have I got something for you, Dan. I won't spoil your conversation here, but you showed me a way that we can actually put that argument to rest once and for all. So I'm going to tee this up and let you take it from here. Tell us what you've got, what you did for us here today, Christi.
Right, perfect. So I went into my files and I found two cases. One is about 8 years old and the other one is about 10 years old. And what's interesting about these two cases is that they are both $2.1 million settlements The first case missed the opportunity to do a structured settlement. It was all cash, and I was given the task of protecting and replicating as much of that money for this injured woman as I possibly could. So that is the cash case. In the structure case, this $2.1 million, $1.8 million was used to purchase a structured settlement that pays the trust monthly, and $300,000, the remaining $300,000 was used to seed the trust. So what have we got here? I've redacted some of the pertinent information, but basically what I wanted to show you was a comparison. We've got investment returns from a month to date, quarter to date, year to date, last 12 months, last 3 years, last 5 years, and this performance inception. All right, so you've got your yellow, arrows up, and I think our faces might be covering up the cash. So if you want, I can tell you basically what's happening is that both of these cases came out to be about 7%. And so you think about it and you said, well, hold on, how can that be? Well, with the cash.
The cash, the people that are saying you shouldn't do a structure are giving them a different number. They're telling them something like this, though, aren't they?
Right. Okay, great. So you've pulled that up. Terrific. So this is the S&P 500 total return during this similar period of time at 13%. That's right. I'm running into situations where I'm being asked to kind of justify why, as a trustee, I continually want to use the structured settlement as a foundation for this family when people are comparing them to the S&P 500. Well, the S&P 500 is 100% risk. The structured settlement is relatively 0% risk.
And so interject real quickly, just to emphasize again, you said this once or twice earlier, but your responsibilities prevent you from taking that full risk because you have to have some securities in here or you'd be derelict in your duty.
That's correct.
Okay.
That's correct. I must diversify the asset holdings. I must use a prudent investment standard. And, you know, quite frankly, there's no one that I can think of that would ever put a catastrophically injured person's money into the S&P 500 100%. Yeah. You have to protect it. You have to manage the risk. That's a lot of what having a trust is all about, is having your trustee manage your risk for you.
So over a period of time, the returns are about similar, but one of the things we discovered here when we were taking this earlier, what happened last year? They're reversed.
You love this column. You love the last 12 months, the last 3 years, and the last 5 years. And quite frankly, you should. So let's look at this, right? Cash is at 12%.
Yeah.
The structured is at 18%. You go to the 3 years. Cash is at 6%. The structure's at 7%. You go to the last 5 years. Cash is at 10%. The structure's around, 10. It's starting to level off where they meet one another. A lot of this has to do with the fact, Dan, that no matter what you're doing, when we're dealing with a trust, we're spending money constantly. We're always spending money. We're spending money to support people. We're spending money on vehicles, home, maintenance, insurance, extra therapies. I mean, travel, the list goes on and on and on.
Yeah.
And when you've got a cash account and you're spending money and there's a down market, it's a double whammy. It's a volatile situation. Whereas in the structure, when you have that structured settlement money coming in and you can plan for it and it's guaranteed, you know what in your budget you can afford to do and you can take it one step at a time.
Perfect segue to this next one. You've got some circles here on your cash flows.
Yes.
What's going on with this one? Same case, 2.1 million. What's happening here?
All right, so here it's broken down a little differently by year, and I wanted to show you kind of where I spend money and where I earn money. I thought that would kind of be most specific for you and your audience. So let's take a look. All right, so we've got yearly amounts, we've got beginning values, net contributions, withdrawals, and investment earnings, okay? This first case on the top is the cash, and like I said, we're always spending money. So this net contribution, there's no money coming in. We invested all of the funds from day one, so there's not a reoccurring income. So any money I spend will always be in the negative. Negative 70, negative 92, negative 280, et cetera, et cetera.
Okay.
Now over in the investment column, that's where we're looking at earnings or losses. So we got 9,000, 172, 284, minus 107. So let's take a look at 2018, okay? 2018 in the cash account, we have 1.8 million. My client ends up wanting to buy a home that year, so we spend 280,000. And in the same year, we have a down market and our investments lose 107,000, which brings us down to 1.4 million. When I say it's a double whammy, that's what I'm talking about. I have to spend that 280,000, but that means I've got to sell assets at a loss in a year when the market is down. That's kind of the 1-2 punch that I was referring to earlier.
Yeah, and looking at this over this 8-year period of time, this is consistent with what I know about the S&P 500. If you look at the whole history of the S&P 500 or any index really, pretty much every roughly 1/3 of the time, 1/3 of the years out there, the market's going to be down. Market's usually positive 2/3 of the time, down 1/3 of the time. You just never know when that 1/3 is going to occur. Here it happened to be spaced out nicely, but you can't count on that because you might have 2 years in a row that are horrible, followed by 3 years that are good. You just don't know.
That's right. And those all cash trusts, that's where you get the high volatility, which we don't prefer.
But down here, there's nothing negative here on this left-hand column with the structure, and these losses are much more manageable. I mean, they're still negative, but you're not taking out big chunks of $107,000 like you would have in the cash account.
That's right. Down at the bottom, you've got the case where it's 2.1 settlement, but 1.8 of it paid for a structure to pay us $55,000 a year. So I budget accordingly, work with the family. We have things laid out. Turns out that they don't need all of that $55,000 every year. So I have money left over. And that allows us to do some dollar cost averaging. It allows us to offset some of the losses. I mean, just look at 2018. I've still got 25,000 coming in, even though I lost 44,000 in the investment account.
Great.
It levels it off. It changes the volatility so it's smaller. That's what I mean when I'm trying to tell everybody, I like having the structure to build the foundation, to lay the foundation for the rest of the trust.
And I kind of like the Aesop's fable analogy where you've got the tortoise and the hare, where the hare might look great, does real great for a while, then sleeps for a while, but who wins in the end? The one that's coming along just here, I'm moseying along, I'm going to get in, I'm going to keep paying, I'm going to win because I'm doing this steadily, consistently over time, and that's the sensible way to do this, it seems like.
I think I agree with you. I absolutely 100% agree with you.
And I love this graphic here because it kind of brings it all together and visually makes us all realize what you're talking about. What do we got here?
So what we got here is, kind of a big picture. I wanted to kind of tie it all together. We've been spending a lot of time talking about investment accounts, but there's much more to that in a trust. You've got fixed income, which would be the bonds and the structured settlement annuities. You've got equities, stocks, mutual funds, ETFs. A lot of our clients need cars or handicap accessible vans. We hold the motor vehicle title to those vehicles. So that's also an asset of the trust, a depreciating asset, but an asset of the trust. And then a lot of people need housing. They need a home, a condominium, somewhere that they can live safely that is retrofitted to help them lead a better quality of life. So here I've taken down more of what was included for all of these settlements. So again, $2.1 million settlements. You've got the cash giving a return of about 7.55%. You've got the structure trust coming in with a return of about 6.95%. It's very, very negligible. We're not talking 3% versus 13%. When you add the whole picture, every client has more of a whole picture. You've got you've got a situation where, look at the structure, for example, that fixed income, that's guaranteed almost no risk money. 1.8 million was that blue stuff.
Yeah.
So that means we were able to participate in the marketplace. We were able to buy those equities to offer a kicker to kind of help mitigate inflation and fees and taxes and things of that nature, without really putting too much of the client's money at risk. Well, compare that to the cash. We've got half of that trust in equities.
Yeah,
We
and
also have
interestingly, the one on this side, because so much of this is secure, it actually frees you up to maybe take a little bit more risk with this than you might otherwise over here, because you can't take more risk using, you go to Las Vegas, if you walk in there with $10,000 and you lose 1,000, that's not such a big deal maybe, but if you only walk in with 1,500 and you lose 1,000, that's a big deal. So
that's right.
Keeping this here, this is so much more risk than this one, and for a half a percentage point over about 8 to 10 year period, that seems crazy. Who would want to take that risk? I'd take this one 100 times out of 100, I think.
I agree with you.
Yeah,
I agree with you, which is why I think our conversations over the past year have led us where we are today, where we wanted to share some real life examples, things that have been in the books for years and years and years, people that are in maybe the second or third phase of their trust administration. This is something that, I wanted to show you and your viewers.
Yeah.
This is how it's really working when the rubber meets the road. This isn't theory. These are actual cases with real life families behind them.
This is terrific, Christi. Thanks a million for doing this. I could go on for a long time, and I suppose anybody that wanted to talk with you for another hour on this topic, you'd be glad to entertain them. But for that, any closing thoughts as we say goodbye to our folks here?
Well, I just wanted to thank you for the opportunity to kind of highlight some of the work that we're doing with people across the United States. And if anybody has any sort of questions, comments, or concerns, I'm more than happy to have a discussion with you. But Dan, really, thank you for your time today.
You bet. And I just have to add, I can think of at least one case, and we've worked on several, but I think of one in particular where, you got involved, and you're involved. You're not just a financial person. You're kind of a quasi mom, friend, spiritual advisor, hand holder, you name it. You're kind of all these things in one, not just the money person. There's a lot of emotions that go into this, and your involvement is really key to that. And that really made a difference on that one case that I know of.
Yeah, we're very, very honored to be in the position that we are when we're chosen to serve as trustee, because it is an intimate relationship. There are a lot of difficult questions and conversations that we have about emotional feelings, not just about money, but where the relationships are, where they're going, and things like that. And it's our job to advocate for our client, not just for the finances, but also for, relationships and where we're spending that money, and getting people, in the example that you're alluding to, relocating somebody across the country from one parent to another, and all of the emotional turmoil that entailed, and knock on wood, I can tell you that we are honored to be a part of that for people's families.
Well, keep up the good work, Christi. And with that, I'll also say to anybody, if you have questions about anything we can help you with, please give us a call. We're here for you. And other than that, I'll just like to say on behalf of the group and ourselves, thank you again for the opportunity to be of service here. And I hope we pass the audition. Thanks a lot, everybody. Talk to you later.
Thank you.
All the best.